One man turned a $9,000 trading account into over $82 million in just 8 years. Meet Kristjan Kullamägi, a trader who went from blowing up his accounts to becoming one of the most successful swing traders in history. But what was his strategy? Kristjan's core trading strategy, known as the breakout trade, is built on momentum and trend-following principles. As I delved into his methods, one element stood out, a subtle yet crucial part of his approach that holds the key to his extraordinary gains. It's about mastering a dynamic balance between controlling risk and letting profits run to their full potential, a technique so powerful it redefines what's possible in trading. It starts with identifying stocks that have made a significant price increase, typically between 30% and 100%, over just a few weeks. Such moves are strong indicators that a stock is gaining serious traction, often driven by institutional investors or major market catalysts. But for Kristjan, the price increase alone isn't enough. He looks for confirmation by analyzing the stock's moving averages, specifically the 10-day, 20-day, and 50-day simple moving averages, SMAs. These moving averages play a critical role in his analysis because they smooth out price data, helping to identify the underlying trend without being distracted by short-term fluctuations. For Kristjan, the alignment of these three moving averages is key. During the stock's initial surge, the 10-day SMA should be above the 20-day SMA, and the 20-day SMA should be above the 50-day SMA. This stacked alignment of the SMAs indicates a strong and sustained uptrend. Additionally, all three moving averages should be sloping upward, confirming that the trend has momentum and isn't just the result of a short-lived spike. Kristjan uses this configuration to gauge the level of institutional interest in the stock. When large investors start accumulating shares, the price often moves higher in a steady, sustained manner, causing the shorter-term moving averages to rise above the longer-term ones. This behavior is a hallmark of a strong, trending stock with the potential for further upside. Stocks that exhibit these characteristics are often driven by underlying catalysts, such as earnings surprises, industry breakthroughs, or favorable macroeconomic conditions. These catalysts attract widespread attention, increasing both price and volume in a way that aligns the moving averages. By focusing on this setup, Kristjan ensures that he's trading stocks with a proven track record of recent strength and momentum, making them prime candidates for further upward movement. After the initial surge, Kristjan waits patiently for a period of consolidation. This phase is crucial as it allows the stock to digest its gains and prepare for the next leg higher. Consolidation typically lasts between 2 weeks and 2 months and is characterized by the stock moving sideways within a defined range. During this phase, the price action should remain relatively calm, with low volatility and smaller daily price movements compared to the initial surge. This indicates that the stock is stabilizing rather than reversing, which is essential for confirming the trend's strength. Kristjan closely monitors the highest and lowest points of the consolidation range during this period. These levels are critical as they help determine the entry and risk parameters for the trade. Ideally, the range of consolidation should be narrow, reflecting reduced activity and the absence of significant selling pressure. A tight consolidation range often signals that buyers are still in control, and the stock is merely pausing before its next move. For example, if a stock surges from $30 to $45 over 3 weeks and then consolidates between $40 and $45 over the next 4 weeks, Kristjan would identify $45 as the key breakout level and $40 as the critical support level. The tightness of this $5 range and the reduced volatility provide a clear structure for planning the trade. The smaller the consolidation range, the better, as it suggests a more orderly pullback or pause, which increases the likelihood of a successful breakout. The trade is triggered when the stock breaks out above the consolidation range. Kristjan enters the trade as soon as the breakout occurs, setting a stop loss just below the low of the breakout bar or the consolidation range. The placement of the stop loss is crucial. It must allow for normal price fluctuations while protecting against a significant reversal. To achieve this, Kristjan uses the average true range, ATR, a measure of the stock's recent volatility, to determine an appropriate distance for the stop loss. For example, If a stock breaks out at $46 after consolidating between $40 and $45, and the ATR of the stock is $2, this means that the stock typically fluctuates within a $2 range during a single trading session. Given this, a stop loss at $44, $2 below the breakout price, would align with the ATR. This placement ensures the stop loss is not overly tight, which could result in the trade being closed prematurely during normal market fluctuations, while still providing a reasonable level of risk control. To be even more cautious, Kristjan may opt to place the stop loss slightly below the low of the breakout candle itself, rather than strictly relying on the ATR. For instance, if the breakout candle's low is $43.50, setting the stop loss at $43.40 ensures that the trade has room to breathe without being stopped out by minor price movements. This approach accounts for the natural volatility captured by the ATR, but provides an additional layer of safety by anchoring the stop loss to a specific price point from the breakout candle. This method is particularly useful when the breakout candle is larger than usual, as it reflects heightened volatility that might need extra consideration. Once the trade is open, Kristjan's trailing stop loss is where the magic happens. This method of managing trades is the cornerstone of his success. His method of using a trailing stop loss based on the 10-day or 20-day moving average is the cornerstone of his ability to achieve massive profits while keeping his risk tightly controlled. This approach allows him to let his winners run for as long as possible, capturing significant upward trends, sometimes exceeding gains of 100%, while keeping potential losses small and manageable. Kristjan typically begins by taking some risk off the table early in the trade. Within 3 to 5 days after the breakout, he sells 1/3 to 1/2 of his position to lock in initial profits and reduce exposure. This partial profit-taking ensures that even if the trade reverses unexpectedly, he has already secured a portion of the gains. However, the real potential for extraordinary returns comes from the remaining portion of the trade, which he manages with a trailing stop loss. The trailing stop loss is tied to the stock's 10-day or 20-day moving average, and Kristjan only closes the position if the stock closes below this moving average on a daily candle. This subtle but powerful rule enables him to ride the trend for as long as the stock remains strong, without being shaken out by minor fluctuations or intraday volatility. By waiting for a confirmed close below the moving average, he ensures that the trade exits are driven by a meaningful shift in the trend rather than noise. For instance, if a stock breaks out at $46 and rises to $50 within 3 days, Kristjan might sell half his position to lock in an initial profit. If the stock continues climbing, reaching $60, $70, or even higher over several weeks, he lets the trailing stop loss do its job, keeping him in the trade as long as the price stays above the moving average. If the stock eventually closes below the moving average at $68, he exits the rest of the position, capturing substantial gains on the remaining shares. Kristjan's disciplined use of stop losses creates an asymmetric risk-reward profile. With his risk per trade limited to 0.25% to 1%, losses have minimal impact on his overall account. For example, with a $100,000 account, his maximum risk per trade is $1,000. Yet the upside is practically unlimited because his trailing stop loss keeps him in trades that continue to trend upwards. This is where his strategy stands out: small controlled losses on losing trades and massive trend-riding gains on winners. By focusing on letting his winners run and cutting his losses quickly, Kristjan aligns himself with one of the most fundamental principles of successful trading: maximizing gains while minimizing risk. His disciplined use of the trailing stop loss is not just a method for protecting profits, it's the engine that drives the remarkable profitability of his strategy. It's this commitment to a structured, data-driven approach that enables him to consistently achieve exceptional returns while maintaining tight risk management, turning small risks into massive opportunities. After starting as a trader in 2011 and experiencing multiple account blowups, he refused to give up. By 2013, he achieved consistent profitability with his strategy, and by 2017, he reached financial independence. Over the years, he transformed a modest $9,000 account into a staggering $82 million, a feat that has earned him recognition as one of the most successful swing traders of his generation.